Marcus and Sarah both got the same alert on their phones the same Friday morning. Their broker had finally given them an allocation in the SpaceX IPO, the one everyone had been talking about for months. Same amount, $2,000 each. Marcus bought the second the market opened, riding the excitement, watching the ticker climb in real time like it was a video game. Sarah read one paragraph of the prospectus, the part about the company still not being profitable, closed the app, and didn't buy a single share. Same alert, same warning, same $2,000 sitting in their accounts. And the gap between what happened to each of them next is the entire reason I'm making this video. I'm going to walk you through exactly what happened the day SpaceX went public, who got rich in the first 10 minutes, who was quietly forced to buy shares whether they wanted to or not, and the one mechanical fact about index funds that almost nobody explained to people like Marcus before they hit buy. My name's Nick, and I want to give you one idea to hold on to for the rest of this video, because it's the thread running through the entire story. Just because everyone around you is celebrating doesn't mean the deal in front of you is the deal you think it is. I call it the confetti effect. The louder the party, the harder it is to see what you're actually buying. And the cruel part is, the bigger the IPO, the louder the confetti gets.
Quick disclaimer before we go further. I'm not a financial advisor, and this isn't personalized advice. This is just what actually happened, with the actual numbers. So you can see why the excitement and the reality weren't quite the same thing. Let's go back to that Friday morning and actually look at what Marcus was buying into. SpaceX sold 555,555,555 shares, priced at $135 each. Run that math and you get just over $75 billion raised in a single morning, the largest amount any company has ever pulled out of the public markets on day one in history. The old record belonged to Saudi Aramco back in 2019 at $29.4 billion. SpaceX didn't just beat that record, it nearly tripled it before lunch. And the valuation behind that raise pushed the company above $2 trillion, more than every major airline in America combined, more than the legacy defense contractors combined, for a company that, by its own admission, is still spending more money than it brings in.
Here's where Marcus's story and Sarah's story start pulling apart, and it has nothing to do with luck. It has to do with one sentence Sarah actually read and Marcus skipped. The company is not yet profitable. Real revenue, yes. More than half of everything launched into orbit on Earth goes up on one of these rockets, 8 million people paying for Starlink. But the market didn't price SpaceX on what it currently earns. It priced SpaceX on what it might become. And that gap between earns and might become is exactly where Sarah's instinct to slow down and Marcus's instinct to jump in started writing two very different outcomes. Now here's the part that almost nobody explained to either of them, and it's the part that should bother you more than the trillion-dollar headline. When a company this enormous gets folded into a major stock index, every single fund that tracks that index has no choice in the matter. The rules force it to buy shares immediately, mechanically, whether the fund manager thinks the price makes sense or not. One financial reporter covering the listing live described it almost too bluntly, saying these index funds were essentially forced to buy SpaceX stock, as if the company had offered 3 times the number of shares it actually did. Think about what that means for a second. That's not investors doing research and deciding the price was fair. That's billions of dollars of buying pressure getting dumped into the stock automatically before a single retail investor like Marcus even got a chance to think it through. By the time his order actually went through, the price had likely already been pushed up by exactly that kind of artificial demand, the kind that has nothing to do with a rocket company and everything to do with rules written years before SpaceX ever filed to go public.
Picture Marcus that morning, the way I picture him, sitting at a red light with the app open, watching the green number climb, feeling for the first time like an investor who finally got in on something big. He doesn't know about the index mechanics. Nobody explained the confetti effect to him. He just sees the number going up and the fear of missing out doing the rest of the thinking for him. He texts his brother a screenshot. He tells himself this is the smart move, the move his future self will thank him for, the same way he told himself the same thing about a different hot stock 2 years ago that he doesn't bring up at dinner anymore. That feeling, that exact feeling, is the entire product being sold on IPO day, not the rocket company, the feeling. Meanwhile, Sarah is doing something that looks almost insultingly boring by comparison. She's reading, not gut feeling, not the green number, the actual filing, the part most people skip past entirely because it's dense and unglamorous and nobody posts screenshots of it. Here's what she found that made her close the app. Ahead of the IPO, a venture capitalist sitting on the company's own board owned more than 500 million shares, about 7% of the entire business. And that same board member's firm does enormous amounts of business with the company's AI division. Equipment leases worth more than $20 billion, with over $1.5 billion already paid back between them. None of that is illegal. All of it is disclosed right there in the filing for anyone willing to actually read it. But a board seat and a stake that size, tangled up with billions of dollars flowing between the same handful of people, isn't the kind of detail that makes it into a headline about a $1 trillion celebration. Sarah read it. Marcus didn't. That's not a difference in intelligence. It's a difference in which one of them let the confetti do the deciding.
One portfolio manager, speaking the same day the deal closed, put it about as plainly as anyone in finance ever dares to say it on the record. He said, investing in an IPO process is genuinely speculative, that it's difficult to know where a stock like this is headed on any given day, and that anyone thinking about buying in should understand they're speculating, not investing for the long term. That wasn't a competitor trying to talk the deal down. That was someone inside the business, telling the truth about his own market the same week everyone else was popping champagne. So let's actually run the numbers the way Marcus and Sarah's $2,000 played out, because this is where the story stops being abstract and turns into something you can hold in your hand. Marcus's $2,000 bought him roughly 14 shares at the offering price. Exciting morning, no question. The kind of morning that feels like it deserves a screenshot. But here's the part that should make you slow down, the same way Sarah did. Companies that debut at valuations this extreme have a well-documented habit of disappointing afterward, with a large share of them losing roughly half their value within just a few years of their first trade. That's not a guess about this specific company. That's simply the pattern, again and again, whenever a stock launches priced for a future that still has to actually arrive on schedule. In a business where the rockets it depends on have a real history of failing mid-test, and where not being profitable was just as true the day before the bell rang as it remains the day after. Marcus is holding 14 shares of a story that has to go exactly right for years to justify what he paid for it today.
Sarah's $2,000 never left her brokerage account that Friday. It sat in the same low-cost index fund she'd been quietly feeding every single month for 2 years. The boring fund that, by the way, was now mechanically forced to go buy SpaceX shares on her behalf anyway, just spread across thousands of other companies at the same time, with none of the concentrated risk Marcus just took on by himself. She got exposure to the same stock without betting her $2,000 entirely on one outcome arriving on schedule. That's the part I actually need you to feel. Sarah isn't smarter than Marcus, and this isn't a video about Marcus being foolish for getting excited. The confetti effect works on everyone, including people who research investments for a living. The only difference between the two of them on that Friday morning was one closed paragraph and a few extra minutes of patience before hitting buy. Marcus bought the feeling. Sarah bought the boring version of the same exposure, without betting her whole position on a single company's future arriving exactly the way the headlines promised it would.
And if you caught yourself nodding along thinking about Marcus, good, because that's the actual point of this video, and there's no shame in it. The confetti effect doesn't only show up on the biggest IPO in history. It shows up every single time a stock is loud enough, exciting enough, talked about enough that closing the app and reading one more paragraph feels like it's costing you the opportunity instead of protecting you from one. The next mega IPO is already being planned somewhere right now, and the same two reactions will play out in millions of living rooms the day it lists. Some people will read the paragraph. Most people will watch the green number and let the fear of missing out finish the thought for them. Years from now, when people ask what happened with the biggest IPO in history, the headline will still say what it said that Friday: record-breaking, historic, the largest in the world. All of that will still be true. What won't make the headline is which of the two people standing at that red light actually understood what they were holding by the time the confetti settled on the floor.